You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. And now, it's time for the show that breaks down the options market from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike TOSAW from St. Charles Wealth Management, Mark the Greasy Meatball Sebastian from OptionPit.com, Andrew the Rock Lobster GIOVINAZZI from OptionPit.com, and Henry the Flowmaster Schwartz from SIBO. The Option Block is brought to you by SIBO. When it comes to trading volatility, trust SIBO, the creator of the VIX Index, for in-depth and relevant information. SIBO's tools and services gives you up-to-date trade insights, analysis, and positions of VIX options and futures. No matter what kind of trader you are, there's plenty of useful information to take the guesswork out of creating your portfolio strategy and to help you make more educated moves in the market. Visit www.cboe.com/VIX today to learn more. And now, get ready to hit the Option Block.
All right, good afternoon. Welcome to the Option Block, our bi-weekly option trading show that we go into an epic sojourn as to what is happening in the option trading market. We're excited to be here today. Unfortunately, we do not have our fearless leader, Mark Longo. So this is Uncle Mike TOSAW in the guest host hot seat for today. And Andrew and I are going to do our best to make things happen, do things well, do things right, to honor our fearless leader as he is out among them, doing wonderful things to enhance the network and the option trading society in general. So without further ado, what I would like to do is introduce my co-host for the week, Mr. Andrew GIOVINAZZI. Andrew, how are you today?
I am doing quite well, Mr. TOSAW. How are you? I hear a little birdie is I heard a little birdie about a strategy block later. Something like that. I believe down the road in the future.
Well, it's Monday, so I mean we can definitely do that. So I mean, I can pull double duty. I can do a strategy block and I can host all within the same show.
That's, that just shows how flexible and resilient you are. I'm using the buzzwords from like the 2000s. Flexibility and resilience, I believe, were big buzzwords back then.
For sure. I'm going to go back to one from the 90s, a solution. We're going to be solution-oriented with our flexibility and with that one. So without further ado, let's go ahead and dive into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right. So on the trading block today, kind of an interesting start to the week from the standpoint that we're down slightly to start the week. The low of the day right now for the S&P 500, we're at 50.91. So we did dip below the 5,100 mark. We were down 30 at one point, but as it stands right now on the S&P, we are only down roughly 10 on the day. So we do have that. The VIX is up 15 and a half. It's up 15 and a half. That would actually be more. That would be a little bit more interesting for the trading block. The VIX is up 78 cents at 15 and a half on the day right now. In the bond world, we're not really getting a ton of movement. In the silver world, in my beloved silver, not a ton of movement, nor in the gold. So precious metals, we're not getting a ton of movement to see anything. With that being said, it doesn't look like we're getting a lot of extreme excitement happening right now, but there's always extreme excitement happening in Maine. Andrew, what are you seeing right now?
Actually, I guess maybe if you're hunting or something, there's extreme excitement, but I don't know if people come to Maine for extreme. Well, I guess there's snow. There's a snowmobiling club in Maine. It's quite popular. All through the county and up north, people snowmobile. So I guess that's exciting in the wintertime.
Riding down a trail at 80 miles an hour sounds exciting to me.
Yeah, they definitely they've got some it's very popular up there. I didn't realize how big it was. They have their own club and their own like snowmobile radio and all kinds of stuff. Anyway, okay, well, here we go. I saw something very interesting in Twitter today. So if anybody doesn't follow, there's this guy, Vance Harwood. He is, and he's been on VolViews, I think, several times. A very good volatility guy, and he's tweets some good stuff. And he is noticing, same thing I am, this, and I got to ask Russell, but he's noticing how the VIX term structure has kind of been compressing, meaning the futures are getting cheaper relative to cash. Normally there used to be some, there's some volatility premium, and somebody's kind of selling those, selling those futures, and they kept getting closer to the cash level. Like the sort of the old edge in the VIX is kind of getting squished out. It feels like now. Normally you have more of that when volatility is lower, and then when the short-term volatility gets higher. So it appears, at least for the short term, that some volatility is coming out of the futures relative to the cash. However, one thing that I have noticed, Mark and I both noticed, is we have had higher lows for VIX in the last 3 months. Now, we have all this zero DTE action, which provides, pretty much infinite gamma to, a liquidity provider. Basically what that means is, if you're buying short-term options, the amount of gamma for a liquidity provider, and gamma is just how your delta changes. That sounds trivial, but it's not, because if you have a relatively large position, let's say you own 20, 30, 50,000 SPX contracts, in that expired today, that's huge amount of gamma. Obviously a lot of decay, but decay doesn't mean anything if the market moves. So, because most liquidity providers they're not taking really a directional position. They're mostly taking a gamma volatility type position. So, you have this huge gamma, let's just call it not a bomb, but this huge, gamma factor short term. And let's say retail and funds and in pension funds, whatever, who are selling short-term options to liquidity providers. And then, so what are they going to do? They're looking to lay off some of the juice that they have. So, they're going to sell, they're starting to be more aggressive sellers of VIX futures, and compressing that volatility lower. Now, I thought this was interesting, because normally you have kind of that flat to backward volatility when we have like sharper short-term volatilities. So and I'm kind of curious to see is if it's CPI related or not, meaning we've got a lot of data coming out, a lot of CPI data, CPI producer prices and stuff like that, which this last year has been moving SPX hugely, 10 to 20 points SPY in 3 to 4 days, which at this point is like 3-4%. Now, their market is now pricing this short-term vol because we have a CPI number. Like, okay, if the number's okay, do we take off again and get to all-time highs? And all-time highs in SPY would be, I believe, was it 517, something like that. We traded, yeah, almost 518 SPY, which is 8 points away, which is it's like a 1.5% move, 1.75% move. So how do you price that volatility in the short term? So if you're a liquidity provider and you're looking at that, you're like, oh, okay, so I'm going to jack up the short-term options. And sure enough, so like I was buying weekly option strangles, and that is a call and a put with 4 days to run the last few weeks when everybody thought, I believe, that the number really didn't mean anything. And they were pricing those strangles for like 5 days, like $3-4. So you're basically buying a week of time, a strangle, like a 4-point strangle. So that's 2 points out of the money for the put, 2 points out of the money for the call for like $3 or $4, like $3.30, $3.40, stuff like that.
So you need a 50-point move in the S&P, it sounds like.
Exactly. You would need a basically a 1% move over the week for it to pay. And as well as I do, like a 1% move a week lately. That's
not out of the question.
Not out of like 1% move a day, right? So,
right.
It's been kind of sneaky around these numbers. So I think the market had been underpricing, and again for the reasons I described earlier with Vance's tweet, where there's sellers of vol, sellers of short-term vol. All those puts go out worthless. Let's say. Or a lot of the juice goes out worthless, and the liquidity provider hedges by, maybe they do, I don't know, it was speculation, figured out a way to kind of smarty pants selling the 30-day future and VIX and buying short-term options. But today though, for the March 15 cycle, and I bought some strangles on Friday. I've already closed the puts today, so I have the calls for a little credit right now. But but that strangle today is now like $5, where even a week and a half ago, that strangle was only $3.50. So whatever's going on, the market is definitely pumping up the vol big time in the short term. And as I recall, like the more those shorter term vols are hot, the higher the shorter term vols, it lifts the curve up, and you get a more backward shaped VIX curve.
Well, let me ask you this about that, Andrew. So in terms of like it being pumped up, is it possible that the vol for the time frames that you were mentioning was just pumped down and now it's coming back up to normalized levels, or do you think it's definitely getting higher? I mean, what's your take on that?
I think it's now being more reflective of the move that should happen. So before, I think they were underpricing the move because there was more sellers of options and the liquidity provider could get away with it. And the liquidity provider, in general, liquidity provider community is a buyer of options, so they're always trying to compress volatility. Right? Because if you're always if tomorrow you're going to buy an option and the next day you're going to buy an option next day, you're always trying to get that weekend out. You're trying to compress prices as much as you can get away with until, retail starts buying options again and the vol goes back up. So I think what happened was they were able to price it very low for a while. And now I think you're correct. Like all of a sudden they're looking at it saying, wait a minute, we're going to pop vol. the weird thing is this hasn't shown up like in close to close vols haven't been that high. But what you have is you have, let's say, a low volatility. So I'm up a little every day for the week, but by the end of the week, I'm up 2.5 or 3% or something like that. So if you're buying a strangle and you're holding for the week and you only paid 1% for it, by the end of the week, you're 3%, you have a huge winner. And I think now they're, at least the way the pricing looks, that all that stuff has popped up a little bit. And we're expecting much more of a move. Like the at the money strangle right now is priced around $8. I'm sorry, the at the money straddle is $8 in SPY for Friday. And then there's a divvy, but that shouldn't make a huge difference in the price of it. Obviously, SPY goes down by the dividend and all that kind of stuff, and the options adjust. But relative wise, it's still a pretty pricey strangle. Even the 14th, the strangle that expires the day before the dividend is $6.50. So, like, this is like, yeah, they've definitely pumped it all up. Like, volatility for the March 14 cycle today is up 4 points. So that's basically they took the weekend out and they stuck it all back in plus some. So if you sold options for this week, they're not even decaying. They're actually going up in value because, traders think we're going to move, substantially more, at least what we're priced on, at least what we're priced. So I thought that article was interesting. So it appears from Vance, I'm kind of like droning on the volatility thing here a little bit, but I thought that was interesting. But I've also noticed we have made higher lows for VIX since December. We had a dead low of 12.5, or I think just under, like right around 12.25 for VIX. And we haven't closed that low since, with the market making all-time highs. So is it because volatility is being dragged up because the market keeps going in one direction, which I believe? But I'm not trading in the SPX anymore. So without actually being in there, I don't know, but I can just look at how the vols do, and I go, that's what I recall in the 90s when the market just kept going up and up and up. Vol at the money just kept being dragged up. So I think we're just, until there's some kind of relief rally, we will go back to a more normal, let's just call it a VIX, like a more contangled structure with the front end. I think the front end is so bid right now because I think folks think the market's going to move this week, and I don't disagree with them. I think if you have a benign CPI number, we're going to be back to all-time highs again, just because that's what the market's been doing. I'm not trying to overthink it too much or look for the next big crash, but from a trading point of view, it just, and I think the idea of, if you have covered calls and maybe your stock gets called away, this isn't a bad place for that to happen. So anyway, that's mostly from a vol point of view, and that we've come up from all-time highs. And then NVDA had a 100-point intraday swing Friday. Like, things are moving. It might not look it from a realized vol point of view, but there's definitely pockets of the market that are moving quite a bit. So I'll kind of end it there on my my volatility soapbox, as it were.
So let me just add one soap chip, so to speak, to the soapbox, or ask you to add one soap chip or one bar of soap to the soapbox, whatever way you want to put it. So right now with the VIX, the typical 10-to-1 ratio of movement, meaning if the market is up 1%, then that means the VIX is down 10%. I know that's a very overgeneralized thing, but today what we're seeing is the market down 0.1% and the VIX up 5%. Now, I know there's the weekend effect that comes into play, but that's definitely a movement to where vol's coming into the market. Then would you say that that's indicative of that for sure?
Oh yeah, 100 for sure. Like, because what you're catching now is, and this is what I pointed out last week, the 5,200 calls, which were the next even handle up. Vol was expanding at the strike. Vol's expanding its strikes all over the place. So is it because folks are buying? But it's for sure that vol is expanding. So not only did you get the weekend effect, basically the weekend effect is just, the liquidity, there's like a theta vega give, meaning like the liquidity provider, sort of lowers the value of the options by the days of decay, but that also equates to some vega number. So, 1 point down in volatility, 1 point up in theta. So on a Monday, what happens is now all of a sudden, basically the trade day and the sheet running day basically sort of get back to the same. And the vega comes back, I would say not comes back into the option, but the time is sort of synced up again. And it always looks like a markup in vol. That's usually about 0.65, 0.7 for VIX. Today we're up, I think, 1 point overall, but volatility across every term is up. So it's definitely more of a, vol expanding, straddle expanding. A straddle was at $120 yesterday. It's 121 today, when it should be down money from theta, from decay. So the whole weekend effect is kind of getting around that weekend decay cycle. So yeah, like vol was definitely higher. And on Friday, I sold most of my VIX calls just because, we had some numbers this week, but we don't sell off. So we're getting the bump in volatility without SPX delivering the 1.5, 2.5, or 3% down move in like a day or two. You don't get it. We're not getting it anyway. So, right now we look like we're about to be, green on the day. So I guess they leak in the CPI number again, but
no, that never happens.
That would never happen, right? So another part is like, when the market has a hard time pricing one direction. So like, think of it this way, like if NVIDIA just keeps going up, let's just say it keeps going up and doesn't stop, which is not very far from what's happened. Like if you're a liquidity provider or you're trying to price this, how do you price that? So at the beginning of the week, the weekly straddle, let's say, is $50, but NVIDIA goes up 100 every week. So even though like the volatility might be quote unquote correct, the fact that you have the path dependency, right? Up, going straight up, the straddle value you started at 50 is now worth 100 intrinsic value because you're up $100. And like, so, how does the liquidity provider price that? Well, they price it by just making the vol continually go higher and higher until they could sell the options for what they think is enough to manage, the underlying move. And I think we keep seeing that. And the thing now is when you look like what does being up 13 or 14 weeks mean from a volatility perspective? And it's and I think it's the market we see right now. It's very reminiscent of, I remember in the 90s, like you would, when you were a floor trader, like in the internet era, there were so few call sellers that like I would buy option contracts at almost any price because the gamma was worth it. I know that sounds hard for people to understand, but because it was sort of the dot-com boom and everybody just thought things were going to go to the moon, they didn't speculate by writing covered calls. It was the opposite. They just bought calls, hundreds of calls, thousands of calls relative to back then. Now the volumes are totally different. But you couldn't buy options back then. There was no natural seller because the retail coming in just bought. And we're starting to see, I think anyways, from what I can observe from my perch, right? I'm not a liquidity provider anymore, but I believe that's what's happening again in different pockets, right? Like NVDA, the semi space, having SMH go up like $40 in, I don't know, a couple of weeks or something. I mean, those are huge moves in relatively big stocks. And the liquidity provider community is only so big, and they're going to adjust by making vols higher. So, just looking at NVIDIA today, although today looks a little quieter for the stock, it's down $8. I think it was up $10 at one point. So it's a $20 range, which lately is about nothing for the stock. So we're seeing all that kind of action. So I'll kind of leave it there, but I think, this week, just from a pricing point of view, we're either at all-time highs again, or we have kind of a, oh my gosh, inflation is back sell-off. So we'll see how real that sell-off actually gets. But right now they're pricing this week's options around, $7-8 for between the 14th and the 15th after all the inflation numbers and stuff come out. So there's definitely a bid to the number, which we haven't seen the last couple of weeks, but the last couple of weeks, all of like the Humphrey Hawkins testimony, all that stuff, all of it was just totally underpriced. All the short-term options were totally underpriced. So for like my subscribers in Option Pit that, kind of rode these trades with me, it was good. It was fun. And now we're looking at the next thing. So, but I think that's where we find ourselves. So we'll get some idea tomorrow. I think we have the CPI number is core CPI is Tuesday for February. So all those numbers come out at 8:30. So whatever the bell will be rung as far as what we have out of that, and we'll see if the historical pattern has held true. Whatever move you get on that day tends to continue for the next 2 or 3 days, and then we'll see if VIX can actually, if it holds up after this week. Then I would say there's something definitely weird going on. Maybe there is a structural change in volatility. It could be, but it would be. But after all these numbers have come out, vol's not coming down. VIX is not coming back to a 13 or a 14. And I mean, if vol's not coming down, it generally means something's going to move. So, and I'd say it's an interesting time we live in. Let's say, how about that?
It's always good to be living in interesting times, that's for sure. Yes. So, speaking of interesting, see, I can't quite do the segues like Longo does. That's his thing. He'll come up with a word that wasn't really that big in what you said, and then he'll make it into a segue. I gotta give the man credit for that. He's very good at it. But with that, let's go through our top 10 of the day for most actively traded equity options. And so with that being said, we have at number 10, Google, 194,000 contracts traded, 132,000 calls, 62,000 puts. ADV is 370,000 on Google. Next, we have Boeing at number 9. One of my favorite things about Boeing, I remember talking with someone early in my career, telling them I was doing some trading strategies with Bank of America. And he said, if you did my strategy with Boeing, it would cut down 1/3 of your work. Didn't understand the joke that he was saying, but then I looked at the ticker symbols and realized that this gentleman was telling an option trader's version of a dad joke, because it's one less symbol that one less letter you have to type in. Boeing, 220,000 contracts, 98,000 of them calls, 123,000 of them puts. So on there, we have a little bit more put heavy in Boeing. Number 8, we have Amazon with 227,000 contracts traded, 149,000 on the call side, 77,000 on the put side. Now, I'm going to just take a little bit of an interruption here with Amazon, just because of the fact that I've talked about this a little bit in the strategy block in the past. And one of the reasons with which I'm able to set up certain collars to where you have it set to where you have a very minimal downside, like maybe 0.5%, and then you have the potential to get an upside of close to 10% over the course of a year. Amazon is one of the stocks that I've used that with. It may or may not be available right now, so I'm not sure. But the point is that at the money put can sometimes trade for the same amount as an out of the money call. And by doing that, the reasons are twofold. Number one, we have row again. Row's kind of a new thing. Interest rates, you actually can get money on stuff you invest in the fixed income space. That's kind of a new thing to this market. And sometimes when I talk to people, the newer guys on the trade desk, they think it's kind of weird to them. But the other reason is that when you have stocks where there is that much more demand on the call side over the put side, it can definitely play a factor in as well. And so some of these that we're reading today are definitely more call heavy, and that can also play a factor in where we're going with it. Number 7, Mara. We have 252,000 contracts traded, 188,000 are calls, 63,000 puts. Blantier, we have 253,000, and the ratio there is 185 to 68, so definitely more calls in the mix. Next, we have Meta, the stock formerly known as Facebook. 405,000 contracts. The call to put ratio is 268 to 138. Next, we have Advanced Micro Devices at 514,000. The ratio there is pretty close to being split down the middle, 261,000 to 253,000. Next, we have the stock at number 3, the stock that is up on the day. The market's flat on the day, but the stock's been getting its butt kicked lately. It's kind of weird to say butt kicking and this stock in the same sentence, but it's the fruit company, Apple. Apple is number 3 on the list. 611,000 contracts traded, 450,000 calls, 160,000 puts. Number 2, we have NVDA, 943,000 contracts traded, 568,000 calls, 375,000 puts. And then number 1, we have Tesla. 1.05 million contracts traded. Ratio is 654,000 calls to 394,000 puts. So there's definitely a little bit of bias on the call side with Tesla. And with that, we are then going to segue into our next segment, and that is the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome to the Odd Block. This is the portion of our show to where we look at things that are, how do we put this, odd. It's interesting. Through the years on the Odd Block, one thing that we have definitely determined is that the big money isn't necessarily the smart money. And I think we have done on the show collectively, since we started doing this show, we've probably done close to 3,000 Odd Block segments. Is that crazy or what, Andrew?
Wow, that is crazy actually when you think about it.
Because we do it twice. Well, actually, I shouldn't say that because we do it twice a week. But no, we're probably just under 2,000 because I know we've done a lot of there's been a lot of odd trading through the years on this show. So I think I exaggerated that term a little bit. My apologies, but it is election season, so exaggerating numbers, I guess I fit right in with the media these days with anything. So
you won't be exaggerating. I would say you're going to be on the light side of exaggeration relative to what's going on in the media right now.
For sure. So first off, Andrew, do you have anything odd that you are looking at right now in the world of oddities?
Well, I do, only because I've been following this stock closely. Robinhood markets.
Ooh, we haven't talked about Robinhood in a while.
Yeah. So, I mean, so this is one of these stocks kind of like Snap, right? Where somehow I think executive class the C level somehow keeps giving themselves a ton of stock. I guess maybe they won't. And they never can make any money, but this was the first quarter, I believe, they had a positive earnings or something like. So basically, Robinhood is finally a profitable enterprise. However, going back Mima, the Memageddon a couple years ago, and they've, whatever it's a very, whatever it is, it's in the lexicon now, Robinhood. So I started buying some of the stock. Galongo and I used to joke in oddities. We were selling like 9 puts, 10 puts. And I never got a sign. So I just said, screw it, and bought some calls. And today I actually did the house money roll in my calls. I was long some June 15s. I think I paid like 65 cents for them. And they're like almost $4 today. So I'm like, okay, how long am I going to play this game? So today was the day. And so I sold them and I did the house money roll. I rolled up to the June 2025 call spread for the same price or relatively close, about 72 cents, I think, average price, right around there, 72.75. And I rolled up. So what I did notice is there was a huge amount of June quarter call buying on Friday. So paper bought 2,400 of the June 25s in Robinhood, HOOD, and they paid around 80 cents for them. And here's what I was talking about, kind of this volatility thing. And you had mentioned it, this volatility effect, or you had mentioned it with Amazon, right? Where you could buy the at the money put and then sell that longer term out of the money call. And because interest rates were so high, that's going to pump the value. Like calls become, when interest rates go up, according to the option model, calls become more valuable and puts become less valuable. And so that rising interest rate will pump those out of the money calls up, which makes a caller a more attractive a trade, because you're holding on to stock, which theoretically you might have to pay broker, you might have to, if you're borrowing money to buy the stock, you'd have to pay that interest. But anyway, for Robinhood, I don't think that's the case, but I'm looking at volatility on the 25 strike is 70, almost 80% in June. That's some volatility, because 30-day realized vol is 50. So you're talking the liquidity provider can and is getting away with selling options that are, $8, $9 out of the money at an 80 volatility, which is 25 or 30 points higher than the realized. So that's a pretty hefty premium. Like if you're going to write some calls, those would be, they're pretty juicy calls to pick up almost $1 to sell those. So anyway, paper paid like in the low 80s for them. And today they're trading around 95 cents and the stock's up 27 cents. So the delta on the calls are like, even though these calls are $8 out of the money, the delta from the move yesterday to today is more like a 35 or 40 delta, which means the volatility is going up in the call. And so what I did is I bought call spreads. I bought the 20 calls. That's why I like, the 20, 25 call spread. The risk reward is pretty good. It's all house money. Basically, I took a little over $3 off the table on my calls, and I'm buying these and you see if we get any kind of roll higher. And I gassed my volume a little bit. I bought a 25 lot instead of the 20 I had on. I'm sorry, I went from a 10 lot to a 25 lot. So I took a little bit of the house money I made and rolled it up. But and that's what we got. So I think like the call spreads look like pretty decent risk reward. Any call spread you really want to buy. Just depends, how close you want to be to the money. But I think Robinhood will be, as long as something weird doesn't happen in the market, people realize that this franchise is going to be worth some money. And they do have quite a bit of cash still. So you're still not paying a ton for the franchise. So anyway, of course, I'm talking my own book because I'm long the call spreads. And I did buy some shares a little while ago as well, just because I wasn't ever getting put and I got sick of it. So sometimes it just works like that.
That's like a white collar problem. I keep selling puts and I can't get assigned.
Yeah, right. So I tell my students, nobody is crying a river for my life. Like nobody's like, gee, poor Andrew can't get assigned his stupid puts in Robinhood. So anyway, that was the paper I saw trading there. And again, today, another day, like stocks up 25 cents and volatility is up all the way across the board because guess what? Paper is buying options. So it's just another one of those days where, there's a lot of call buyers. It's the easiest way to describe it. Like total volume today, let's put it this way. There's 146,000 calls traded and 14,000 puts. So
that should tell you something right there.
I don't know what everybody's doing, but so anyway, that's why I decided to keep the long I have. It's a little less aggressive than what I had before, but I have learned in this game that, I don't want to, when you're in the house money roll state, you just take the money, be happy, and move on to something else. So overall, I'm pretty thrilled with that particular one.
I would be too. Now let's review one from way back in the day. I'm just picking one from October 9th. DLO, some puts, 10,903 DLO October, 17 puts traded at 22.5 cents. And from there, the opening of that day was $18.15. Earnings were on November 14th, and then the stock closed at 18:02 on expiration. Now those puts were still open at expiration. So in other words, the put person, whether they sold it, if they sold it, they were pretty happy because of the fact that they sold it at the 17 level, and it looks like it worked out. So from that standpoint, if you do the math, it looks like the person who sold those puts made $245,000 on the day. Does that seem to be a girlfriend Ferrari trade to Andrew?
You asked that in the nicest way possible. Like it is right around that number, and that's of course why we call it the girlfriend Ferrari number, because I guess they're not buying them the $1 million Ferrari, just the 245. So usually, whoever does this line in the sand thing, don't know who it is, but the number usually comes in around like 200 to 300 cash. So maybe a pension fund, or just somebody really savvy. I don't know, but this does appear to be a line in the sand put, and the value does up, surprising once again for, I don't know, Mike, the 100th, 200th, 300th, 400th time on the show. The premium collected is right around that 250 number, which just so happens to be the price of a not new but slightly used Ferrari. So, and this company is like a Uruguay-based global merchant business-to-business platform. No idea what this is. Like normally, I'm somewhat versed in some of these tickers, but this one just is all the way out of left field. But I guess it looks like it makes money. Has I wonder if it's kind of like some sort of a blockchain thing. But it's actual real. They make real money. They have real revenue and all that kind of stuff. So anyway, very interesting DLO. But yes, it definitely falls under the rubric of line in the sand put. And yeah, it looks like they collect all their money.
Nothing wrong with that. All right, folks, you are in for a treat today. We are about to do not just myself doing a strategy block, but Andrew is going to be combined with me today for something that we have strategically planned for today's double strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the Strategy Block.
All right, so this is something to where Andrew and I were talking about some ideas before the show of some things. I'm like, well, this is what I'm planning on for the strategy block. It's like, oh, I'd like to talk about this. And so it's like, wow, it was like we were kind of great minds think alike type of thing in terms of where we are. So what we're going to talk about is covered call assignment and covered call assignment risk to some extent. And what I'm going to, for my part of it, I'm going to start this out and just kind of talk to you about some things with which we're doing right now with the triple income, in that the triple income is our covered call portfolio that we work through RCM Wealth Advisors. They're the big dogs, so to speak, that my RIA that St. Charles Management works through. And that I'm a big part, or I am the part, so to speak, on the options trading, on the option trading side of it for the covered calls. And we're going into expiration week. And roughly 80% of our covered calls in the portfolio are still not assigned. And I would say, in looking at them, probably of those, that 80%, probably 3/4 of that are kind of right on the borderline. And so typically what we do is, after we enter in a covered call trade for the month, what we'll do is we'll put in an order to where if the and I'll either monitor one side or look at the other side. But if, let's say, the stock goes way down, we can collect 80% of the potential profit on the call premium. We'll get out and start over in some way, shape, or form there. And that would be if the stock were to stay the same or go down. But let's say the stock goes higher. One thing that we'll do is, when we're able to make 80% of the potential profit between the stock gain, if it's out of the money, or the stock doing nothing if it was at the money, let's say, and the time premium going away and making it more in the money value, whatever the case may be, we'll get out in combination with the stock and the short call. And so going into this last week, we're pretty close to being at the money. We're deep in the money on some and we're out of the money on others. But we made the decision this week that we are just going to let nature take its course, so to speak. And the reason is this, is that normally the analogy that I like to use in terms of closing short options is that if you're squeezing a towel, it's very difficult, and you're squeezing water out of a towel, it's very difficult. You're not going to get, it's impossible to make the towel completely dry just by squeezing it with your hands. And so from there, if you're trying to wait for that final nickel that's in the time premium, it's kind of like trying to squeeze out that last drop. However, going into this last week, because of the fact that some of the stocks that we're in, the bid-ask spreads would be not very friendly. And on top of that, it's just a few days. And on top of that, we would likely just have the money sitting in cash for the last few days if we were to get out anyway. We're just going to let nature take its course. And if the stock gets called away, it gets called away. And then we'll just start over again next week. If the stock goes way down, then of course we'll get out of the short call for a nickel or a dime or whatever the case may be. But for this week, because of the fact that we don't want to have to fight a wide bid-ask spread, and the fact that we've made up our minds that we're not doing anything else with the money the rest of the week anyway, we're just going to kind of let it sit. And that's what we're looking at for covered call assignment this week. Now, Andrew, what could cause us to be assigned? What could cause us not to be assigned?
Those are all quite excellent questions, by the way. So, and I would agree with you that why waste the money on the bid offer when you're just going to take delivery anyway, and just have the stock go away? I don't think there's any point to waste that 50 cents or whatever to do that. So I think that's the right call. The second call is what happens. Everybody has to think about what happens when you have call assignment. So if you're a liquidity provider, that means you're long a call, and if you're short like Mike, right, you're expecting the call to be, your short call to be called away. But if you're long a call, you have to think in synthetic equivalence to actually what's going on. So if I'm long a call, how does my position change if I exercise? So you think about it this way. I'm going to sell out my call that I'm long, right? Again, this is being exercised, but the actual action is your call goes from a long call to gone, right? Which means you have to sell it out. And that is replaced by long stock, right? So that's what the exercise does, right? It's going to get rid of your long call. So net effect is you sell that call out and it's replaced by long stock. So the synthetic equivalent of short call and long stock is a short put. So whenever a liquidity provider exercises a call in their position net that is synthetically selling puts, and if at the price that Mike describes, when they exercise, they would be selling the put for zero and incurring interest on the long balance of stock that they acquire in the exercise. So, which means is no call will ever be assigned before expiration because the liquidity provider would be giving up his long puts, essentially his synthetic long puts, and he would incur interest. So there is no reason for a liquidity provider to ever exercise a call, except there's two exceptions. One,
what could those exceptions be, Andrew?
What would they be? Number one, they expect a dividend, right? So they're going to exercise that call the day before XD. So if they think the dividend is worth more, right, then the put on that strike, they will exercise 100% of the time unless there is some screw up. So being assigned for a dividend is theoretical lock unless somebody screws up. And there have been cases where there have been massive screw ups where like clerks have not exercised for a dividend and it becomes a big mess. That's the first case, right? So if your short calls going into a dividend and the dividend is worth more than the put on that strike, on that term, it is likely 99.9% of the time you will be assigned.
And real quick to add to that, we're in the dividend week right now for SPY. So if you have short calls in SPY, so if you're in a short call spread and you don't have the underlying or short calendar or anything that you have a short call on, make sure that you do this analysis that Andrew's talking about, because that's very important.
Yeah, for sure, because that happens like and it's always quarterly, and they're going to assign you on the Thursday, not the Friday. So if, like Mike describes, if you have a short calendar, like it's kind of sneaky, or you have a butterfly that goes in the money, something like that, just be mindful of that. I mean, we'll talk about the results that could be another strategy block. But so the second thing is when a stock is hard to borrow and the liquidity provider needs the long stock, they'll exercise a call to take the long stock because they don't have to deal with the hard to borrow situation. So those are the two times. So if you sell calls just in random, everybody's like, oh, I'm going to be assigned. It is the only way you're going to be assigned is a screw up, basically. If it's not hard to borrow and there isn't a dividend involved, it is likely somebody screwed up, and it is rare. So what this also means is there's no good reason to exercise a call from the liquidity provider's point of view because synthetically they sell puts for nothing. So if I'm a liquidity provider, why would I want to sell puts for nothing? You never know what they're going to be worth the next day. So that's why they don't get assigned. So I see a lot of stuff on, FinTwit and Twitter, and they're describing, when you're going to be assigned and all this kind of stuff. It's all crap, all right? It ain't going to happen. If it happens, it's a total mistake. It's extremely rare. But if there is a dividend and that dividend is more than the value of the put, it is like 99% chance you will be assigned on that contract. And if the stock is hard to borrow, you might see a lot of trades that look too good to be true, like selling vertical spreads for more than the difference in the strikes, stuff like that, where you think it's free money. But as soon as you put that trade on, boom, your short's going to be assigned immediately, and then you're going to have all kinds of problems just because you're going to have to, basically deliver the long stock, or your clearing firm, your broker or dealer is going to they're going to exercise your long because they have to cover the short. So that could be a bit of a problem as well, depending on like what prices you get for everything. So that is basically, let's just call it the long and the short of the exercise. But, like Mike says, like if you're covered and the call's in the money, there's no reason for you to bother to close it, because you're losing the benefit of the trade. I would say the only time that there is a trick you could do if you want. And the trick I do sometimes is if the stock blows way through the strike, what I do is I will buy a call above the strike and then sell the stock out and create a synthetic short call spread for a really good price. Because the stock isn't doing you any good anymore. And by buying the upside call, or maybe you buy 2 calls if you want and back spread the position, but you could buy one and you take the gain on the long stock, right? You take that gain. And then if the stock goes back down again, you're short that call spread for a very good price, right? For a huge credit initially, because remember, you're taking the capital gain on the stock. So that's a little trick. If your call goes way in the money and you wrote it, that is a way to capture the stock, get your stock out of the game. You always have to buy the call first because you might have margin problems. But now you have a short call spread for, what could be a really good trade. Let's say the stock backs off $4 or $5. You closed the short call, so you made an extra $400 or $500 on your trade, and you still were able to capture the buy right credit that you started with. So anyway, there's a lot of ways to think through a trade. Mike and I, we sit here and we don't do anything else all day. What do? We look at options and look at things to do. So you come up with ideas. So that is what I do tell my students, especially if they have a qualified account, and it doesn't matter if they have a capital gain in the stock, and it gives them a shot. So basically, all your in the money calls, all your in the money covered calls can all become synthetic puts, right? For a period of time. You have almost no risk for the synthetic put. And if the market falls apart, you have a big home run. So anyway, that's my little tip: managing a covered call that goes too far in the money. And if you have more questions about that, maybe I'll do a video on it someday and it'll all make sense. Or Mike can explain it in the next strategy block. Either one.
Always a fun time. All right, we are coming up against it, so let's get to Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right. Well, Andrew, we are coming up against it. So what I think we're going to do for right now is what are you looking at in this market coming up? And if our listeners are interested in hearing more about what's going on in your neck of the woods, where can they go find you?
Well, I just realized we never maligned Longo the whole show.
Valid point.
What is he in Florida or Boca or something, just sipping Mai Tais and whatever, talking to people?
Pretty much.
We're doing the show again.
Pretty much, yep.
So anyway, well, I guess that was my shot out. Second one, CPI. If the volatility that they're bidding the market up, are we going to move that much? Which I think we could. And if folks want to learn how to do more goofy stuff with options, go to optionpit.com, and all the products I trade, Easy Trade Button, OP Mentoring, our Pro, Weekly Profit Cycles, all very profitable products. And if you want to learn how to trade options with a little bit of cleverness, come over at optionpit.com.
All right. And then I myself, the host, Uncle Mike, if you would like to learn a little bit more about what I do as a financial advisor who's not afraid of the option product, check out my website, stcharleswealth.com. Would love to have a conversation with any of our listeners. I always enjoy it. If you're interested in working with a financial advisor, and also follow me on Twitter. I try and put out a lot of content, and there should be a lot more coming in the near future. At Mike TOSAW, TOSAW. Well, that is it for today. Andrew, I would like to thank you for coming with me on this epic sojourn, as Mark likes to call it. And unfortunately, we didn't get to the bash on Mark block today, but maybe the next time that we're in the hot seat, we can do that. But thank you, everybody, and have a wonderful day.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.